The clock is ticking, not in minutes or hours, but in decades of accumulating promises and debts that no one can truly pay back. The next crisis will make 2008 look like a walk in the park. And yet, most of us go about our days as if nothing is happening. Governments, corporations, and households have all piled on more debt than at any point in human history. Trillions borrowed, often to fund growth that can no longer sustain itself. Interest rates are rising, inflation is rising, and the warning signs are all around us, quietly ignored, because the system seems too big to fail. But history tells us that systems this big, this fragile, and this indebted don't just stumble, they collapse. The historical mirror. Look back 1,000 years. Look back 100 years. Rome borrowed against the future to fund an empire it could no longer afford. The Weimar Republic printed money to cover its obligations, creating inflation so severe that people carried wheelbarrows of cash just to buy bread. Debt isn't just numbers on a ledger. It's a promise stretched beyond what reality can support. And when the promise breaks, the consequences are never subtle. History repeats not because humans are irrational, but because the mathematics of debt is unforgiving. Compound interest doesn't care about politics, optimism, or hope. Eventually, growth falters, obligations become impossible, and collapse becomes inevitable. Right now, global debt sits at over $350 trillion. That's more than 4 times the size of the world economy. Think about that. For every $1 the world produces in a year, there are $4 owed somewhere in the system. And much of this debt is short-term, high-risk, or dependent on continued low interest rates. The anatomy of the crisis. Debt on this scale is like a massive storm cloud hanging over the global economy. A small spark can trigger a lightning strike, and the storm can turn catastrophic. Government debt. Countries like Japan, Italy, and the United States have borrowed heavily to fund social programs, infrastructure, and military budgets. The problem isn't just the amount, it's the reliance on borrowing to maintain daily operations. When investors start questioning the safety of these debts, interest rates spike, making repayment impossible. Corporate debt. Companies aren't immune. Many have borrowed aggressively during periods of low interest rates, buying back shares, funding acquisitions, or simply surviving without generating enough cash flow. When rates rise, these companies struggle. Defaults rise, jobs vanish, markets panic. Consumer debt. Households around the world are also drowning. Mortgages, credit cards, student loans. The same forces that allowed growth in the past are now a trap. Rising interest rates combined with stagnant wages make repayment increasingly difficult. Every layer of this debt is interconnected. One domino falls and the chain reaction could sweep across nations, industries, and households simultaneously. The global ticking clock. What makes this crisis different from previous recessions is scale and complexity. In 2008, the collapse originated in one sector, subprime mortgages in the US. This time, the problem is systemic. Debt has woven itself into every corner of the global economy. Central banks have tried to prop up the system for years with quantitative easing, low interest rates, and bailouts. These measures delayed the inevitable, but they also created moral hazard. Borrowers and lenders became reckless, believing the state would always intervene. But governments don't have infinite power. Printing money can only work until inflation spirals out of control. Interest rates cannot remain negative forever. Confidence can crumble faster than anyone expects. Debt and demographics. A double whammy. The aging population in developed countries adds another layer of tension. More retirees mean higher social security, healthcare, and pension costs. Fewer workers mean slower economic growth. Debt that seemed manageable in a growing young economy becomes crushing in a shrinking, aging one. Look at Japan. A country with debt over 250% of GDP, low birth rates, and decades of stagnation. Their solutions are limited, and yet they serve as a warning for other nations that will face the same demographic pressures. Emerging economies are not immune either. Many borrowed in foreign currencies and now face stronger dollars and rising global rates. Servicing debt becomes a balancing act on a knife's edge. Miss a step, and default is unavoidable. The psychology of ignoring the collapse. Humans are wired to ignore slow-motion disasters. We notice sudden events, a market crash, a war, a natural disaster, but decades of accumulating debt feels abstract, distant, intangible. Politicians focus on short-term victories, elections, GDP growth, stock market rallies. Corporations focus on quarterly profits. Consumers focus on monthly bills. No one wants to confront the reality of a system teetering on mathematical impossibility. Yet, the collapse doesn't need a dramatic trigger. It doesn't need a single black swan. The combination of high leverage, rising interest rates, and slowing growth is enough. Eventually, the numbers speak louder than hope. How one collapse spreads. The global economy is interconnected like never before. If a major economy defaults or experiences a sudden debt crisis, the effects ripple across the world. Currency devaluations in one country can trigger inflation elsewhere. Banks exposed to bad debt in multiple countries may fail. Trade freezes, supply chain collapses, and capital flight can accelerate the crisis. A collapse in one sector can cascade into the next, turning what might have been a contained crisis into a global economic earthquake. Remember, 2008. It began with subprime mortgages in the US, but quickly spread across Europe, Asia, and every corner of the financial system. This time, the potential is orders of magnitude larger. The role of central banks. Central banks are aware of the risk and they are trying to manage it, but their tools are limited. Printing money, lowering interest rates, and quantitative easing all delay the inevitable, but they also inflate asset bubbles and increase inequality. When the crisis finally comes, central banks will have fewer options. Raising interest rates to fight inflation may trigger defaults. Lowering rates may be meaningless if confidence evaporates. The paradox is clear. The more they try to prevent collapse, the more fragile the system becomes. What could trigger the tipping point? It doesn't take a nuclear event. Often the triggers are subtle. A major economy unexpectedly defaults or restructures debt. Inflation spikes suddenly due to supply chain shocks. Political instability undermines confidence in a nation's ability to honor obligations. Corporate defaults cluster, revealing weaknesses in global finance. Each event alone might be manageable. Together, a cascade that dwarfs anything in living memory. Lessons from the past. Collapse is rarely sudden. Rome didn't fall overnight. Weimar didn't hyperinflate instantly. The signs were there for anyone paying attention. Unsustainable spending, reliance on borrowed resources, eroding confidence, and social unrest. The lesson is uncomfortable but unavoidable. Systems that rely on debt to survive eventually reach a breaking point. The mathematics are relentless. Optimism alone cannot prevent the consequences. Preparing for the inevitable. What can individuals do? What can nations do? Diversify and de-risk. Avoid excessive leverage. Savings in multiple forms, cash, assets, essentials, can help weather shocks. Understand exposure. Know where your risks lie. Mortgage, credit, investments, pensions. Think long-term. Short-term growth can be deceptive. Systems fail slowly at first, then catastrophically. Recognize warning signs early. Demand transparency. Citizens and investors must understand the true scale of debt. Ignorance isn't bliss when collapse is mathematical. Nations and central banks can attempt interventions, but even the most skilled policymakers cannot ignore the limits imposed by reality. The silent collapse is already here. The truth is uncomfortable. The global debt crisis isn't a prediction. It's a slow-moving reality. The collapse isn't visible yet because the system is clever at masking instability. Bailouts, stimulus, and financial engineering temporarily hide the cracks. But they do not eliminate the underlying problem. The math hasn't changed. Debt grows faster than growth. Interest obligations rise faster than revenue. Confidence erodes slowly until it crashes suddenly. The clock is ticking, and when it strikes, no one will be able to ignore the consequences. This is not intended to create panic. It's meant to awaken awareness. Understanding the silent collapse allows individuals, investors, and policymakers to make informed choices instead of being blindsided. The global debt crisis is a story centuries in the making, with lessons from Rome, Weimar, and every system that borrowed beyond its capacity. The stakes are high, the mathematics is unforgiving, and the human tendency to ignore slow-motion disasters is universal. The question is not if, but when. And the next time, it could be unlike anything we've ever seen. Subscribe for more insights into the forces shaping our world before they shape you. Knowledge is the first line of defense in a world built on borrowed time.